They're doing what? I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, you won't believe China's next move because they're putting their banks in jeopardy of triggering an all-out financial crisis, one that could collapse their entire financial system. And this is something the world isn't ready for, but something our subscribers were ready for today was a high probability trade. I'll show you how they're making money, and you can too. Now, let's over to Bloomberg, where we picked today's story up with a headline. It's China's credit growth slows in August as confidence stays weak. And this is very important to understand because what Beijing's about to do is react to slowing credit growth, which is something that central bankers do to begin with, because that's a huge problem. In a debt-based economy, you need a constant and persistent expansion of debt to hit your growth targets and to pay on all of your existing debt. When you start to see it slow down or even worse, contract, well, it means you're on the edge of a recession, if not worse, an all-out financial crisis. The problem is Beijing's going to put their banks in a dangerous position that could collapse their entire financial system. Aggregate financing, a broad measure of credit, increased by 3.03 trillion yuan. That was less than a gain of 3.13 trillion yuan in the same month earlier, though largely in line with median forecasts. So what we're seeing here is a deceleration in credit. And again, this is a problem because old debts get paid off with new debts. And I want you to understand, for a lot of people, when they sell their home, it pays off a debt, and the new buyer often is financing it. So again, we have a system where new debts are constantly paying off old debts. So when we start to see a slowdown in credit expansion, it means big problems are ahead. And financial institutions offered just a bit over 906 billion yuan of new loans in the month, lower than estimated because banks have an issue here. They're looking at the economy, they're looking at what's going on with finances for their customers and businesses, and they're nervous because there's one thing that banks want. When you think about if you lend money, say, to your friends or family, what's the first thing that you worry about? It's getting your money back. And the banks are in the same position. They want to make sure they're getting their money back, and they're seeing the economy weakening, which is why financial conditions are tightening. One of the big reasons why they're lending less money. It's a dangerous game. But let's take a look at some U.S. data here and show you what's happening in China is also starting to happen here. If we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, and we're looking at this against the commercial and industrial lending data. This is weekly data in red that's shown on a year-over-year rate of change. Now, what happens is when central bankers invert yield curves and money curves and make short-term rates higher than long-term rates, which is not what the market wants, well, banks actually make money on the interest rate spread. So when they're inverted where short-term rates are higher, they just can't make money lending, so they tighten financial conditions and issue fewer and fewer loans, only then to people they know for sure are going to pay them back. And that's what's called tightening financial conditions. And as expected here, when we look at the data, you can see very clearly going into the dot-com bubble, banks started tightening financial conditions as the Fed raised interest rates. And look at what happened to the weekly and commercial industrial lending data. It started to decelerate, and then when it broke through that black line across the horizon, you see it entered a contraction. And this happens with a lag. You see it again going into the global financial crisis. Again, financial conditions tighten. We see lending still continue to increase until it rolled over and then went all out into contraction. It's starting to happen now again. As we look at the data, it's flatlined, and we know that as the Fed starts to cut rates, conditions don't get better for banks, they get worse because you tend to see interest rates across the board going down. That's what we're seeing, indicating that financial conditions here are going to further tighten, meaning banks don't really want to lend in this environment. And it makes perfect sense because when they look again about sending their money out into the economy, they worry about it coming back. And when financial conditions tighten, well, what you start to find out is people run into delinquency and then into default. So here we're going to look at the delinquency rate on all loans for commercial banks, and what do you see? That deceleration in lending and ultimate contraction leads to a rise in delinquencies because it comes back to the design of our system that you need a constant supply of new loans, in particular to pay off old debt. And as long as you have that, well, everything seems to work. But when you see that deceleration or even worse, contraction in lending, well, there isn't enough money to pay on all the debts, and next thing you know, you start to see rising delinquencies delinquencies and major pain for banks. So what's happening in China is you see the banks don't want to lend, the economy slowing, and what to expect there is the delinquency rates are going to rise. And here again, you see that in the dot-com bubble, we see it the global financial crisis, and we're in the early stages of it now. Now, the delinquency rate data is only quarterly. It's very, very low, but what we know is it's likely to continue higher here, and we've gotten some data that credit cards and consumer loans are in trouble, and it makes perfect sense. There just isn't enough new money being created to sustain the economy at its current pace. The central bank said it will maintain a supportive monetary stance by preparing to launch some additional measures, further lowering the financing costs for businesses and households, and to keep liquidity reasonably ample. So you can see, the PBOC here reacting to the data saying, well, we've got a problem. We're seeing the demand go down for loans, so maybe we just need to lower interest rates. And at forefront, that does actually make some sense. Perhaps rates are too high and people don't want to borrow at them. Well, problem is lowering rates isn't going to change anything because the PBOC hasn't figured out, just like the other central bankers haven't figured out, the rates need not just go lower, they need to go substantially lower. The figures will likely amplify concerns that the economy might struggle to meet Beijing's annual growth target around 5%, as deflationary pressure now is becoming entrenched, while a housing slump shows no signs of easing, curbing demand for credit to fund investment and consumption. So this is perfect here. They cannot meet their targets because they don't have enough new debt being created and invested in the economy. And so again, you come back to the bank's perspective here. It's not only do they not lending because financial conditions are tightening and they don't see their money coming back, but they don't see any other opportunities. So in turn, what are they doing with their money? Well, they're buying bonds. And this is something Beijing doesn't want them to do. But let's talk about the effects of the federal funds rate against the commercial industrial lending data, because the PBOC, much just like the Fed, thinks, well, if we just cut another once or twice, then everything will be okay. But in reality, we can go back to the 90s recession and we can see the Fed had to substantially cut rates all the way from nearly 10% all the way down to about 3% to get a turnaround in credit creation. And then we go into the dot-com bubble. Rates were roughly around 6.5% and had to go all the way down to 1. Then you see the global financial crisis. We went from about 5.25 to 0. The pandemic expansion, well, that was back at 0. And people believe that we're not going back to 0, but the reality is we've seen major cuts from roughly about 7%. Now, if that happened, we'd be at -1. Of course, we know the Fed can't do that, but the reality is nobody knows how far these central bankers will have to cut to get credit creation to turn around. But the longer they keep rates higher, the more risk they put the global economy heading into a recession, which is only making this more interesting of what Beijing is about to do, what the PBOC is going to do, and it's going to put the Chinese banks in a dangerous position to go completely insolvent. I'm going to show you and how they could collapse their entire financial system. But let's talk about debt and expansion of economies, because Beijing has said they don't want to really rely on debt to expand their economy, but perhaps they should wake up and realize that they are a debt-based economy. That's how it works. Here we can see the U.S. data, real or inflation-adjusted GDP in blue against the commercial industrial lending data. You see they're not perfectly in sync, but credit expansions usually follow expansions in the economy. It makes perfect sense. You want to get things turned around, well, you need to get some credit growth going, and you see the relationship there with the economy leading the turnaround of credit expansion. But you get the two together, because once credit turns around, well, then the economy usually continues to run. And the government is also making a push to reduce mortgage costs as part of efforts to put a floor under the property downturn. Authorities are considering allowing homeowners to refinance as much as $5.4 trillion of mortgages for millions of families, a plan that's expected to spur consumption if implemented. And that's something we're going to eventually see in the U.S., because we know that consumers are loaded up in debt on their credit cards. They're upside down on their car loans. They've got a lot of debt they're struggling to make payments on. And ultimately, the answer to the central bankers will be simple: lower rates, get everyone to refi if the banks will do it, free up cash flow, and everything will be okay. The problem is it takes so long for that to transmit to the system, and the banks won't be eager to refi it because they're going to be in trouble and consumers are going to be out of work. But credit extension is typically stronger in August after a drop-off in the prior month, when banks aren't in a rush to meet their quarterly lending targets. The PBOC cut interest rates in July in an attempt to boost confidence and demand, and yet it didn't do it at all. And that's the problem here. It doesn't actually work because it takes a lot of time. It's going to take more than just a couple rate cuts to get people to go out and borrow and spend. Because you think about the consumer, they're looking at the economy, say, what do I want to go buy? Nothing. And they're even worse. Because when consumers go out and purchase things, they think about paying it back. And if you're seeing your hours work get cut, or if you're seeing people lose their job, and you're seeing your pay increases not going up that much, you start to see your business struggle where new orders aren't coming in, backlogs are going away, inventories are rising. The last thing you do is go out and borrow money to buy something. Think about from a business perspective as well. They look to borrow money to invest and expand their business. This isn't the time. That's why you can tell the banks are going to lead us into this financial crisis, but it's only going to get worse. Let's talk about what the PBOC is going to do, because I am just struggling with how they're going to pull this off and not crash their entire financial system. Because China bond yields now sink to record low with intervention and focus, but something that should be racing higher, well, that's your trading account. As of close of business yesterday, we're now adding we have 4 trades. In fact, we added 2 today, one of them being a high probability trade. You want to beat the machines. We show you how to trade against machines, because when they get short positions and then price moves against them, well, they have to short cover and buy. And that's where we want to show you, position you as a subscriber to be buying and take advantage of turns and when machines are buying. But how do we know it's a high probability trade? Well, we ran a back test, so we actually know. We told our subscribers this is a one of the 2. If you want to take one, grab on that. How about you like trading momentum like the RSI and the MACD and the Stoch and those other technical signals, but you find it difficult? Well, we run a proprietary overlay and we look at momentum over other time periods. Right now, we only have 1 open trade, but it's racing higher. In fact, we believe some of our trades are going to go up quite a bit. And we will get a back test done for Momentum Time Pro, but right now we have it for our CTA subscribers. They can download the data, they can look at it. We tell you where the probabilities of success lie. Here's the best part. You get the daily reports. You get every signal. I go through them and give you my opinion on them. You get the backtest data. You get the stop loss levels. You get a full track of trade and returns on a weekly basis. And they even update the stop loss levels for you on Saturdays. You get a 30-day free trial and the confidence that you can make money trading just like my subscribers, just like I do. Links in the description below. Jump on that 30-day free trial. Why do my friends not do it on their reports? Because they know you're not going to make any money. But I do. The development underscores a wide gap between where traders and Chinese policymakers think bond yields should be. And while the former only wants to get their hands on the safest assets amid a moribund economy and prolonged property crisis, the latter are concerned that a bursting liquidity-fueled bubble could jeopardize financial stability. Now, we know this is happening because where are the banks positioned to begin with? They lent a bunch of money to the property sector. And we know there's a bunch of unfinished or empty homes in China. There's no demand for them. And here's the problem. We're seeing the economy slow down there. We're seeing consumers say, look, I don't want to buy a house in this market. I have no confidence I can pay the mortgage. And that's a problem, because what it's going to do is lead to a collapse in housing. That's going to lead to a collapse in banks, which makes the move the PBOC is going to do even more outlandish, as they're going to intervene more aggressively to sell bonds and lift yields from time to time. But why would they do that? It makes absolutely no sense, but yields will still likely trend down. It will take a big improvement in the economy and corporate profits to reduce the bearish sentiment. It's because of PBOC. This is something central bankers don't get either. That interest rates are a function of growth and inflation expectations. Why China would want to sell bonds here, I don't get it. It makes absolutely no sense. They want rates to come down, but that's not the only crazy thing they're going to do. Because let's take a look at the effects of interest rates on growth and inflation expectations. As we look at U.S. 2-year Treasury yields here against real GDP and the average of the consumer price index, we're adding those together, dividing them in half, and what do you see? Interest rates go down because, well, the economy slows. The economy does well, interest rates go up, and you see interest rates coming down. It's effect of the economy, and right now we see a lot of traders and investors shorting the Treasury market, but that's changing in a big way now. As we're entering a bull steepener, we're seeing the economy slow down and likely to get worse. But here we see President Xi Jinping's latest call on officials at all levels to achieve the country's annual growth target of around 5% offered a fresh boost to the rally. Let's get yields up, because that will actually help. No, it won't. He just doesn't realize it. And to some, that means Beijing will typically need to ease monetary policy support, a move that typically leads to lower debt yields. And yes, that's it. It does lead to lower debt yields. But that's not the big bombshell here. That's only part of it. They're trying to drive yields up in an economy that's slowing down, that yields want to come down, and they keep pushing against it. That's not the right move, because the longer they keep yields up, the slower the economy gets, and next thing you know, there's nothing they can do to stop the downturn. But the PBOC is ready to step in, now signaling help for the economy on the way with credit growth being weak, as we talked about. And we will make maintaining price stability and pushing for mild rebound in prices an important consideration for monetary policy and meet reasonable financing demand for consumption in a more targeted way, which is baffling because they're seeing deflation. They're seeing producer prices deflate, and their consumer price index has been in deflation, has now slightly turned around, but the trend is not good. But check this out. The central bank has already made clear that lowering the amount of money lenders must keep in reserve remains on the table this year. And to me, this is absolute insanity. The banks are already heavily leveraged against the property market. And what is the PBOC telling them? We're going to lower the reserve requirement. I mean, you won't have to keep as much capital in case things go wrong, because we're convinced if you lend more, it'll turn the economy around. But PBOC, what if you get this wrong? Which you will. What it means is you're going to see the banks go insolvent. It's going to be an entire financial crisis that could collapse China's entire financial system. And if you don't think that's going to spread all over the world, it will. I think this is a dangerous move. Weigh in the comments, what do you think? As analysts have been forecasting further rate cuts and a reduction to the reserve requirement ratio, with September seen as a potential window. To even worse, the PBOC is being egged on by analysts saying, yes, you should do this. This is a great idea. No, it's a terrible idea, and the banks know it, which is why they're not lending and only buying government bonds. It's very clear. The banks know what's coming, and yet what we've seen is a PBOC making what I consider a move that could collapse their entire financial system. And yet the Fed will probably do the same thing, as the Fed now pursues a 3/4 point cut this year, according to economists, meaning they're thinking one cut this month and then one in November, one in December. As a steeper pace of cut aligns with increasing worries about a slowdown in hiring and a rise in the unemployment rate over the past year. That has helped bolster the case for starting to normalize policy now, before inflation has fully cooled to the Fed's 2% goal. Economists see policymakers' median unemployment rate forecast edging up to 4.3% this year, up from the 4% projected in June. And 80% economists saw risk to unemployment as weighted primarily to the upside. And if they think this thing caps out at 4.3, boy, they are completely delusional about this one. As we see the Fed funds rate against the unemployment rate, we know when the Fed starts cutting, unemployment rate goes up, not down. In fact, there's no evidence at all, not one bit of it, that suggests that cutting rates will help the labor market. What suggests is things are about to get worse, and all these experts have got it wrong. But one former Fed official, Dudley of the New York Fed, sees the case for a half-point Fed rate cut next week, and he's right, because what's happening is central bankers are going to start to panic. Even China needs the Fed to cut rates and hope to stoke consumer demand here. It's too little, too late. And Dudley, who led the New York Fed until 2018, has said that he's citing a slowing U.S. labor market with risks to the jobs greater than lingering challenges to inflation, and supporting his call for a half-a-point reduction. He also highlighted Fed Chairman Jerome Powell's comments at Jackson Hole last month, underscoring not wanting to see further weakness in labor. Of course, we know in the past, Fed chiefs will cut rates ahead of declining inflation, particularly when the labor market starts to go. We know the Fed's going to cut. I think he's going 50 basis points. What do you think? Weigh in the comments, because the question is, why don't you just get started? It's basically up to Fed Chair Powell to see how much support he has for being more aggressive. And I guarantee he wanted to cut at the last meeting. He's going to cut at this one. And my bet is he's going 50 basis points, because he doesn't want to be on the wrong side of this. But little does he know, just like the path that China's headed down, we're on the same path just behind them, and cuts to funds rates not going to be good for the labor market. It's going to make things worse. And as you now see in China, if they cut the reserve ratio, it's putting their insolvency of their entire financial system at risk. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.